So, if you have a significant chunk of cash just sitting in a standard checking account right now, you are essentially leaving a pint of premium ice cream on the kitchen counter.
Oh, yeah, just hoping it stays frozen.
Right, and you're just hoping it stays frozen. I mean, it might look perfectly safe sitting there, right?
Yeah.
Nobody's actively breaking into your house to steal it.
Yeah, the money is still technically there.
Exactly. But the environment is completely wrong.
Yeah.
And because the environment is wrong, that asset is slowly, invisibly melting away.
It really is.
So today we are doing a deep dive, pulling apart a rather eye-opening 2026 financial guide titled The Cash Conundrum, HYSA versus Treasury Bills 2026.
It's a great read.
It really is. And our objective for this deep dive is to figure out the absolute smartest place to park your cash this year without taking on unnecessary market risks based on what's in this text.
Right, because the text introduces this really crucial concept of the hidden leak.
Yes, the hidden leak.
Which is basically the combination of inflation and taxes just quietly draining the purchasing power of your cash. And this happens even when you think you're making the safe, responsible choice.
So explain that a bit more, because the environment right now in 2026 makes this hidden leak particularly dangerous to ignore, doesn't it?
Oh, absolutely. We are operating in a landscape where interest rates are highly attractive compared to, the near zero rates of the previous decade.
Right.
So because the baseline yield on cash is higher, the opportunity cost of leaving your money unoptimized is just massive.
It's huge.
If you're just leaving cash in a traditional checking account, you aren't simply missing out on a few extra dollars. You are actively losing purchasing power every single month.
Because of inflation.
Exactly. I mean, your $100 is still $100 on paper, but it buys less and less at the grocery store.
Yeah, you really have to generate yield just to tread water against inflation.
You do. But, and this is the kicker, the moment you start generating that yield, you run into the second half of that hidden leak.
Which is taxation.
Bingo. Taxation. That fundamental tension-needing yield to fight inflation, but needing to protect that yield from being devoured by taxes. That's the core conflict we're looking at today.
All right, let's unpack this. Let's start with the default choice the guide highlights for fighting back against inflation, which is the high yield savings account, or HYSA.
Right, the go-to for most people.
Yeah, for anyone paying attention to personal finance over the last few years, the HYSA has essentially become the modern gold standard.
Totally.
You open an app, you link it to your primary bank, and suddenly your idle cash is generating a 4 or 5% yield.
And the text notes that these are primarily offered by online banks, right? Because they lack the massive overhead costs of physical brick-and-mortar branches.
Right, no free coffee in the lobby.
Exactly. So they can pass those margins on to the depositor.
Yeah.
And, I mean, the appeal is obvious. It is totally frictionless.
Oh, absolutely frictionless. Like, if your transmission blows on a Tuesday, you tap a button on your phone, and you can pay the mechanic by Tuesday afternoon.
Right. The appeal is entirely about extreme liquidity and just psychological comfort.
Yeah.
The interface looks exactly like the checking account you've used your entire life. Assuming you're using a reputable institution, you have the backing of FDIC insurance up to $250,000.
Which is a big safety net.
Massive. It requires zero investment knowledge, zero understanding of bond markets, and just zero friction to access.
But, and here's where we get to the catch, the text is very careful to outline that this frictionless, perfectly smooth experience comes with a massive, often overlooked price tag.
Oh, it really does.
First off, the interest rates are entirely variable. A bank can simply send you an email on a Friday afternoon announcing that your rate has been slashed.
Yep, happens all the time.
You have absolutely no control over that yield moving forward. And more importantly, every single dime of interest you earn in that account is fully taxable at the federal, state, and local levels. So if the bank can change the rate on a whim, and the government takes a significant cut of whatever interest you do manage to accrue, I mean, is this really the ultimate safe haven? It seems like the HYSA is charging a rather steep convenience fee under the surface.
What's fascinating here is that it is an incredibly steep convenience fee, and people routinely ignore it because they fall for the illusion of the advertised gross yield.
Oh, totally. The big shiny number.
Exactly. The guide really emphasizes this psychological blind spot. You log on to an online bank's website, you see a 5% yield advertised in massive, bold text, and you mentally calculate that you are making a 5% return on your money.
Right.
But you're not making 5%. You really have to look at the realized return, the after-tax yield.
Okay, let's actually run the math on that to see the size of the leak, because quantifying this is where the source text gets really compelling.
Yeah, let's do it.
Let's say you have $50,000 parked in a high-yield savings account, and the bank is advertising a 5% yield. On paper, that is $2,500 a year in interest.
Right. Sounds great.
But if you are a relatively high earner living in a state with a high income tax, so somewhere like California, New York, or New Jersey, how much of that $2,500 is actually yours to keep?
Well, after you pay your federal marginal tax rate on that interest, and then your state income tax, and potentially a local or city tax, depending on your zip code, a massive chunk of that yield just evaporates.
Like, how much are we talking?
You might be paying 30% or 40% of those earnings straight back to the government.
Wow.
So instead of taking home $2,500, your actual realized return might be closer to $1,500.
That's a huge hit.
Yeah, your true after-tax yield is closer to 3%. You essentially just paid a $1,000 fee for the luxury of a sleek app interface and immediate liquidity.
You just paid a $1,000 convenience fee.
Yeah.
That totally reframes the entire concept of a savings account for
They really should.
So if taxes are the primary driver of this hidden leak, the text points us directly toward the waterproof alternative, which is short-term Treasury bills or T-bills.
Yeah,
Now, for an audience that understands personal finance, but maybe hasn't waded into buying government debt directly, explain the mechanics here, because buying a T-bill isn't like depositing money into a bank.
No, it's a completely different mechanism, which is actually why there's a learning curve that keeps many savers away.
Right.
Treasury bills are short-term U.S. government debt. When you purchase a T-bill, you are quite literally lending your money to the United States government to fund its operations for a highly specific, brief period of time.
Okay, and the text mentions specific timelines, right?
Yeah. The source text notes they are issued in standard maturities of 4, 8, 13, 26, or 52 weeks.
So under a year.
Exactly. We are dealing entirely with terms of 1 year or less. And because they're backed by the full faith and credit of the U.S. government, they carry essentially zero default risk.
And the tax advantage is the main structural difference here. The text makes it clear that while you are still responsible for federal taxes on T-bill interest, the earnings are entirely exempt from state and local income taxes.
That's the huge draw.
Yeah, so if you go back to our California example, shielding those earnings from state taxes represents a monumental mathematical advantage over the HYSA. But I want to clarify how the government actually pays you this yield.
Sure.
Because it's not like a bank account that drips pennies into my account every month. The source says they are bought at a discount. How exactly does that math work for the listener?
So the Treasury Department doesn't drip pennies into your account at the end of the month like a commercial bank does. They utilize a discount mechanism.
Okay.
Imagine you want to buy a $1,000 Treasury bill. You do not hand the government $1,000.
Right.
Instead, you buy the bill at a discount based on the current interest rate. Let's say you pay $980 upfront.
Okay, I give them $980.
Right. The government takes your $980. You hold that bill for the duration of its term. Let's say it's a 4-week bill.
Got it.
The day that 4-week period matures, the government deposits the full face value, so the full $1,000, into your account. Oh, okay. So the $20 difference between what I paid up front and the face value I received at maturity, that's my interest.
That is the yield. It is a very clean, predictable transaction.
I see.
The government prefers this zero coupon structure for short-term debt because it vastly simplifies their debt servicing. I mean, they don't have to manage monthly interest payouts to millions of different bondholders.
That sounds like a nightmare.
Yeah, they just settle the difference at maturity.
But wait, if I buy a 26-week T-bill, I am committing my cash for 6 full months. What if the macroeconomic environment shifts?
That's the risk.
Right. Like, what if I lock in a yield today and suddenly the Federal Reserve hikes rates next month, pushing new T-bill yields significantly higher? Aren't I trapped in a bad deal?
Well, trapped is a strong word, but yes.
Or, conversely, what if a massive personal emergency hits in month 3 and I desperately need that cash? How waterproof is this asset if my life circumstances change abruptly? This raises an important question, right? This is the critical trade-off of government debt. You are sacrificing liquidity for yield and tax efficiency.
Makes sense.
If you need the money before the bill matures, you cannot simply ask the Treasury to cancel the deal. You have to sell that T-bill early on the secondary market.
Okay.
And selling on the secondary market introduces interest rate risk, which is also known as duration risk.
Let's break down how that secondary market actually works, because the text mentions it as a hurdle, and it's a massive factor in why people hesitate.
So if you need to liquidate a T-bill early, You sell it to another investor through a brokerage.
Okay.
The price that investors are willing to pay you depends entirely on what current interest rates are doing.
Right, because rates fluctuate.
Exactly.
Yeah.
If you bought your T-bill when rates were at 5% and a month later rates jumped to 6%, nobody on the secondary market is going to pay full price for your 5% bill
Right.
when they can just go buy a brand new one yielding 6%.
Oh, obviously not.
So you will have to sell your bill at a deeper discount, meaning you take a loss on your principal.
So you essentially have to put your bond on clearance to make it attractive to a buyer.
Exactly. That's a perfect way to put it. Now, conversely, if interest rates drop to 4%, your 5% bill becomes highly desirable and you could sell it for a premium.
Oh, nice.
But the overarching point is that the secondary market introduces volatility and hassle. I mean, you have to execute a trade, pay potential brokerage spreads, and accept market pricing.
Yeah, that's work.
It completely shatters the illusion that T-bills are as frictionless as cash.
Here's where it gets really interesting, because when you look at the source text's comparison, the exact same dollar amount requires a totally different strategy depending almost entirely on the clock.
Yes.
It's not about which asset is fundamentally better. It's about matching the financial vehicle to the human timeline.
That is the whole point.
So let's explore the specific real-life scenarios the guide uses, because they highlight how mental accounting can either save you or cost you thousands.
Okay, let's run through them.
In the first scenario, a person has a $10,000 emergency fund. Their transmission might blow up tomorrow, or their roof might start leaking next week.
So in that scenario, treating the money like an investment is a mistake.
Right.
An emergency fund is an insurance policy, not a wealth-building tool. Emergencies do not respect maturity dates.
They really don't.
If your roof is actively leaking water into your living room, you cannot tell the contractor that you need to wait 4 weeks for a Treasury bill to mature.
Please hold off on fixing the roof. My T-bill hasn't matured.
Right, and you certainly don't want to be navigating the secondary bond market while dealing with a crisis. So for true emergency funds, the high-yield savings account is the only logical choice.
Okay.
You willingly accept the tax drag and the variable rate in exchange for the absolute guarantee that your money is available at 2:00 a.m. on a Sunday.
Right. You are paying that convenience fee for peace of mind. Now, look at the text's second scenario. You have cash saved up for a massive family vacation next year, or perhaps you're setting aside money to pay an upcoming property tax bill.
Okay.
You have the cash right now, but you definitively do not need to spend it for another 6 months.
Treating that vacation money like an emergency fund is where the hidden leak drains your wealth.
Interesting.
You know your exact timeline. By putting that specific pool of money into a 26-week T-bill, you achieve two vital things.
Which are?
First, you lock in today's yield. If the Federal Reserve unexpectedly slashes rates 2 months from now, the banks will immediately drop their HYSA yields.
Right. But you're locked in.
Exactly. You won't care because your T-bill rate is a contractual obligation from the U.S. government. Second, you shield those specific earnings from state taxes.
Which gives you more money for the vacation.
Exactly. You end up with tangibly more spending power when it's time to actually book the flights or pay the county tax assessor.
Okay, the third scenario in the guide looks at a retiree. They are living off their cash reserves and need highly predictable income to manage their day-to-day budget, but without taking stock market risks.
For retirees, the calculus shifts heavily toward Treasury bills, primarily because of taxation. Okay.
Retirees are often meticulously managing their adjusted gross income, or AGI, because it dictates everything from their tax brackets to their Medicare premiums.
Right. AGI is huge for retirees.
Because T-bill interest is exempt from state taxes, it can meaningfully improve a retiree's after-tax return without taking on corporate bond risk or equity market volatility.
And it's predictable.
Yes. Furthermore, the locked-in nature of the T-bill provides absolute certainty. They know precisely how many dollars will be deposited into their account on a specific date, allowing for rigid, reliable budget planning.
So the math heavily favors the T-bill for anyone in a high-tax state who knows their timeline.
Definitely.
But there is a massive dilemma introduced in the final scenario of the guide, which is saving for a house down payment in a year.
Ah, the classic dilemma.
Yeah, say you have $50,000 you're saving to buy a house in about a year. You absolutely want the high after-tax yield of the Treasury bill. Losing a chunk of your yield on $50,000 to state taxes is a painful prospect.
Nobody wants that. But you also need optionality. What if the perfect house hits the market in 3 months? You cannot afford to have all $50,000 locked up in a 52-week bill, unable to act on a real estate opportunity. Does the saver just have to pick a side and suffer the downsides?
They don't have to compromise. And the guide's ultimate solution to this dilemma is the Treasury bill ladder strategy.
The latter.
Yes, the latter. This strategy is designed specifically to bridge the gap between wanting high, tax-sheltered yield and needing consistent, rolling liquidity.
Okay, break that down for us.
The core concept is that instead of taking your $50,000 and buying one massive long-term Treasury bill, you slice the capital up into tranches. You buy several different bills with staggered maturity dates.
Okay, walk me through the exact dollar flow of building that ladder month by month so the mechanics are perfectly clear for you listening at home.
Let's assume you divide your $50,000 into 4 equal chunks of $12,500.
4 chunks, got it.
You use the first chunk to buy a 4-week T-bill. You use the second chunk to buy an 8-week T-bill. The third chunk goes into a 13-week T-bill. And the final chunk goes into a 26-week T-bill.
So you have 4 different contracts with the government, all maturing on different schedules.
Precisely. Now fast forward 4 weeks. Your very first bill matures. The government deposits your principal plus the interest right into your brokerage account.
And what do I do then?
At that exact moment, you have a decision to make. Has the perfect house hit the market?
Let's say yes.
If yes, you take that cash and use it.
Simple enough.
But if no, you take that entire lump sum and you reinvest it by buying a new 26-week T-bill, putting it at the very back of the line.
Okay, and then another 4 weeks go by and your original 8-week bill matures.
And you face the exact same decision. You evaluate your need for cash, and if you don't need it, you buy another 26-week bill. By the time you get through the initial setup phase, you have built a system where a significant portion of your net worth is maturing and becoming fully liquid every single month.
So what does this all mean? Building a ladder is essentially setting up a revolving door of cash.
I love that analogy.
Yeah. Every few weeks, a massive chunk of your money walks back through the revolving door into your hands. You look at it and ask, do I need you today? If the answer is yes, you pull the cash out of the system.
Yep.
If the answer is no, you push it right back out the revolving door to go work for you again at the new current interest rate. It solves the duration risk problem because you are never waiting more than a few weeks for a tranche of liquidity.
And if we connect this to the bigger picture, the revolving door analogy highlights why this strategy also mitigates reinvestment risk.
How so?
Well, if interest rates are climbing, you aren't trapped in a low-yield long-term bond. Every few weeks, you have cash freeing up to capture the new, higher rate.
Oh, that's smart.
Right. And if rates are falling, you still have your longer-term bills locked in at the older, higher yields. It is a highly efficient, self-sustaining cash management machine.
But doesn't it take a lot of work to keep buying these bills every month?
Actually, no. Modern brokerages have largely automated this process. You can select an auto-roll feature when you buy the bill, and the brokerage will automatically reinvest the maturing funds into a new bill until you explicitly tell them to stop.
Oh, wow.
Yeah, it requires almost zero maintenance once the ladder is built.
And it completely solves the ultimate dilemma of the house down payment. You aren't forced to choose between the extreme convenience of the bank and the optimized yield of the government. You get to engineer your own liquidity timeline.
You really do.
Which leads directly to the final overarching conclusion of the source material. The smartest strategy for most people in 2026 isn't aggressively tribal.
No, it's not picking just one.
Exactly. It's not about moving every penny you own into T-bills or leaving every penny in a HYSA. It is the hybrid approach.
The hybrid approach is about assigning specific utility to specific tools. It requires viewing your cash not as one giant static pool, but as a multi-tiered ecosystem.
Right.
Your absolute true emergency fund, so the money you might need with zero notice, sits in the high-yield savings account. You willingly accept the tax drag on those specific dollars because liquidity is the priority.
Makes total sense.
Then your known upcoming expenses, the property taxes, the tuition payment, the vacation go into individual, targeted T-bills to lock in the yield and eliminate the state tax burden.
Yeah.
And finally, your large medium-term cash reserves, like the down payment or the core of a retiree's safety net go into an automated T-bill ladder.
So by breaking your cash up, based on its chronological utility, you seal the hidden leak.
Exactly.
You stop losing purchasing power to inflation. You stop paying unnecessary state taxes on money you don't need tomorrow. And you completely avoid the nightmare scenario of having your wealth locked up in a secondary bond market when a crisis hits.
It really requires a fundamental shift in how people view cash. Cash is no longer a passive mattress you sleep on. It is an active portfolio that requires strategic allocation based on timelines, just like an equity or real estate portfolio. Time is the ultimate deciding variable. Understanding exactly when you need your money is what dictates the required tax and yield strategy.
So as we wrap up this deep dive into the 2026 cash landscape, the core takeaways are abundantly clear. First, unoptimized cash is a melting asset. I mean, you must generate yield to survive inflation.
You have to.
Second, high-yield savings accounts are the undisputed kings of convenience and immediate liquidity, but the tax drag makes them a poor choice for long-term holding.
Absolutely.
And third, Treasury bills are the heavyweight champions of tax advantages and predictable locked-in returns, provided you understand your timeline.
Provided you know when you need the cash.
Exactly. We often treat all our cash as one big monolithic pile with one general job title savings.
Right, just throwing it all in the same bucket.
Yeah, we throw it all in the same bucket, check the balance on an app, and just hope for the best. But based on the hybrid ecosystem we've explored today, maybe the secret to optimizing your wealth isn't about endlessly hunting for the single highest advertised rate on the internet.
It's rarely about just chasing the highest rate.
Right. What if it's about treating your cash like a specialized company, where every single dollar gets a highly specific job description and a strict timeline?
Oh, that's a great way to think about it.
Like, your emergency dollars are the frontline responders stationed in a HYSA, ready to deploy instantly at any hour. Meanwhile, your down payment dollars are on a rolling 6-month deployment in a Treasury bill ladder, generating tax-free yield without sacrificing medium-term access.
It completely changes how you view your money.
It really does. Think about it. How differently would you view your own bank accounts tonight if you were forced to write a literal chronological job description for every single dollar you own?
You'd probably find a lot of unemployed dollars just lying around.
Exactly. It forces you to stop treating your money like a static number on a screen and start treating it like a resource that requires active management.
Well said.
So take a hard look at your own mix of accounts this week. Think
Yeah.
about your own mix of HYSAs and T-Bills. Find the hidden leaks in your own strategy. Calculate the state taxes you might be unnecessarily paying and start giving your dollars specific jobs.
Get those dollars to work.
Yes, get them to work. Thank you for joining us on this deep dive into the cash conundrum. Keep your cash working and don't let your ice cream melt on the counter.